real world economy and what's going on, particularly in the equity markets. I'll spend a few minutes talking about the COVID picture, and then talk about government policy and what policy is likely to look like in a Biden administration. And then I'll have some closing thoughts on what the outlook looks like from an economic and market perspective. I'm intending to leave ample time for questions. We got some wonderful questions when you all signed up, and I expect you'll get some equally good questions in the chat box during the course of the presentation today. So let's start the disconnect between Wall Street and Main Street, and I'll use my laser pointer here. It's very interesting. The real economy and the economy as measured by the stock market can be very different. So if you think about the parts of the market that are really affected by social distancing, so retailers, restaurants and bars, entertainment, transportation, tourism, these segments of the economy represent about 19% of US GDP and about 20% of US payroll jobs. Now, if you look on the right-hand side, thinking about S&P 500 operating earnings, these segments of the economy only represent 7% of operating earnings. So I think that's certainly a part of the disconnect between what we're seeing in the stock markets, which are doing quite well, and the real economy, which still is struggling to return to 2019 levels. And in a further, I think, illustration of how the markets are less disconnected from reality than many people think, taking a look at earnings estimates and the change in earnings estimates over the course of the year, I think also helps illustrate the point. Now, if we look on the right-hand side of the page, the parts of the economy that are more cyclical, earnings estimates in energy started out the year with the expectation being that energy earnings would recover significantly and be up 20%. Now, if we look at what the estimates were at the end of August, that's a decline of 104%. Industrials, consumer discretionary, and this is really consumer discretionary, ex-Amazon, and financials, all took a pretty steep earnings estimate hit. Now, if we look on the left-hand side of the page, very different picture. Technology, yes, technology earnings estimates went down, but from 10% to 4%. Healthcare from 9% to 2%. So when you think about what's happened in the market, there starts to be some logic associated with what's done well and what hasn't done well. And the next page really, I think, shows the real dichotomy in the market for much of the year. Now, I realize we've had a little bit of a rebound in more of the economically sensitive stocks in recent weeks, but for much of the year, a small number of companies that have benefited from the stay-at-home economy have done really well, while companies that were relying on economic momentum have done really poorly. So you can see it, online retail, 61%. This is as of last week. Information technology up 34%. Groceries, the run on toilet paper and other grocery supplies has certainly boosted the performance of grocery stores. Home improvement, I don't know about all of you, but a lot of the money that we intended to spend on travel and on going out to eat in my household, we spent on home improvement projects. Now, if we look on the other side of the page, so energy, airline travel has collapsed, commuting to work has collapsed, energy prices have really fallen. Now, this number was more like down 50 to 60% earlier in the year, so we've recovered. Airlines, hotels, resorts, and cruise lines, retail, REITs, really the trend, some of the trends that were hurting retail going into the pandemic have certainly been accelerated because of the pandemic. So again, this divide between the stay-home economy and the economic reopening, there's some logic to this breakdown of market returns. I also want to illustrate how some of what's going on in technology and in online platforms represent really fundamentally different economic constructs than traditional brick and mortar businesses. And I want to use two companies to examine some of the differences between companies that operate more in the virtual world versus companies that operate in the brick and mortar world. So Home Depot, great company, fabulous success story. Home Depot went public in 1981, and the company reached $5 billion in revenue in 1992, so 11 years after its IPO. And then revenues tripled between 1992 and 1996. Now, interestingly, in 1996, despite rapid revenue growth and despite really great success, the company had negative free cash flow of more than $500 million. So, and the company didn't hit free cash flow positive until 2002. So very interesting. Now let's contrast that with Shopify, which is a Canadian e-commerce company that provides e-commerce platforms and some retail point of sale systems. Shopify just went public 5 years ago. The company reached $1 billion in revenue in 2018 and turned free cash flow positive the next year. So very rapid shift from being free cash flow negative to free cash flow positive. This year, revenues are expected to near $3 billion, and free cash flow will hit nearly $250 million. So a very different path to profitability and path to positive free cash flow. And there's some, I think, really logical reasons for these differences. Shopify spent a lot of money up front to build its platform, and there's a success factor in the equation here, in that there's a lot of companies that have spent upfront money to build platforms, and those platforms haven't been successful. So here, Shopify built a successful e-commerce platform, and a lot of their capital expenditures were upfront. And so the marginal revenue and the marginal cash flow from each incremental customer is pretty high. In contrast, Home Depot, they had explosive growth, but they still had to spend a lot of money building new stores, expanding their store footprint, hiring people, building inventory. All of those things were capital intensive. And in the virtual world, a lot of that capital intensity is upfront. And so very interesting economic models. And I thought showing Shopify would be interesting. You probably heard a lot about the Amazons of the world, but Shopify is a little bit more under the radar screen. Now, before you think I'm an unmitigated enthusiast for technology companies and platform businesses, I think there is a definite concern in the space about valuations. Shopify's price to earnings ratio was about 293 times estimated earnings. Their market capitalization is 133 billion as of yesterday. Home Depot trades at a much more moderate 23 times earnings. Now, granted, it's a much more mature company, and they have about a $300 billion market cap. So is $300 billion too much or too little for Home Depot? Is $133 billion too much or too little for Shopify, given their rapid growth and their economic business model? Reasonable people can disagree, but I think it's very interesting to see the contrast between the virtual world and the brick and mortar world. Another factor here, when I think about tech companies and think about what's happened in the market this year, is I think about where we are in the economic cycle and where we are in the interest rate cycle. I hear a lot of comparisons about valuations and what's happening in technology today versus what happened in 2000. And I certainly retain some of my scars from the dot-com bubble and the bursting of the dot-com bubble. But there are, at the risk of sounding like it's different this time, there are some things that I think are really fundamentally different this time. So if we go back to 2000 and we had 12-month forward price to earnings ratios in the neighborhood of 26 times, we were at peak earnings. We were at the end of a long economic expansion and a big economic expansion. Today, we're at about 22 times in the U.S., but I think it's important to keep in mind that we're at relatively depressed earnings because of the pandemic. So the two numbers aren't necessarily completely comparable. The other major factor here is that in 2000, the 10-year Treasury had a yield of 6.5%. Today, we're not even at 1% on the 10-year. And if you think about putting together a valuation of a company, certainly the discount rate that you use to discount future earnings, with rates this low, future earnings are worth relatively more. Again, I'm not an unqualified enthusiast for technology stocks. I think there are vulnerabilities, but I think before you get too worried about those comparisons between 2020 and the year 2000, I think it's important to keep in mind some very profound differences. So now turning from what's happened this year on the markets to the COVID picture, the COVID picture has really deteriorated in recent weeks. So let's start with Europe, and certainly because of pretty dramatic lockdowns, Europe has bent the curve. But look at where we've got to in terms of new cases, and we're still even after some pretty serious lockdowns in places like France and Germany and the UK, which has been a basket case in dealing with the pandemic. We're still at elevated, very much elevated case counts. So I think there's some things to worry about there, even though the 7-day average has fallen by about 30% from the November 8th peak. In the US, there's some slight good news in the Midwest, but we still are very much in the third wave of the pandemic. The 7-day average stands at about 175,000 new cases in the US. If we don't contain the pandemic, I really worry about there being a new wave of lockdowns or other social distancing measures. I think about living life in the Northeast, and we all did a lot outside, and were able to keep ourselves sane really by being outside during the summer and fall. I worry about what the picture looks like in the cold winter months if we don't start to get this under control. And here, it's not just in the earlier phases of this third wave of case counts in the U.S. It was mostly younger and healthier people that were getting infected, but the spread has gone to people who are more vulnerable, and so we see the U.S. total. The hospitalization curve is going in the wrong direction, and I didn't include ICU statistics in these presentation materials, but we're having capacity problems in hospitals and in ICUs in many parts of the country. So again, this is something to worry about. This is one of those cases where I can see light at the end of the tunnel because we've made fantastic progress towards a vaccine, and we've made progress towards treating COVID much more effectively, but we're not quite at the other side. We're partway over the bridge, but and we can probably see the destination in sight, but the destination still isn't upon us. And so I think there's a bumpy ride ahead. So what happens to economic growth as case counts surge? And I worry about a long winter in which economic growth either stagnates or reverses course. One of the things that we've been paying close attention to is national credit and debit card spending trends. And this is what we would characterize as social distancing spending with card-present transactions. So this is things like spending at retail stores, restaurants, hotels, amusement parks, and theaters. And we cratered, we did spending ground to a halt in March and April, but we had a nice recovery over the summer. But now we've started to either stall or turn down in much of the country. And this is really interesting data. It comes from JP Morgan Chase's massive credit card database. So I fear that this number will start to go down if we don't get case counts under control during the winter months. Now, mobility data, and this is largely courtesy of Google, where they measure changes from baseline workplace, retail, restaurants, and transit. And again, we had a rebound in Germany, we had a rebound in the US. We're flatlining in the US. Italy is actually turning downward. The UK had some improvement, and then they had a pretty sharp downturn when Boris Johnson largely locked the country down. So I worry that even though a vaccine is in sight, we're still not quite there at the finish line. Turning from COVID to the policy front, now the markets have been enthusiastic. The two, I think, major pieces of uncertainty have been taken off the table, one being on the health front. Such promising vaccine results takes some of the long-term healthcare concerns off the table, and then the seeming end to the 2020 presidential election also gave the market a breath of fresh air. The market's biggest fear was that we would have an extended period of uncertainty about who the president would be, and I think we're at a high level of confidence that there will be a Joe Biden inauguration on January 20th. When we think about policy, and it's in our view, we frame policy as in terms of constraints rather than preferences. We think constraints are really what drives what's going to happen from a policy front. And just from what as an example, what I mean by that is Joe Biden campaigned on a platform that included very aggressive spending plans and pretty significant rises in taxation. It was definitely a tax and spend platform, certainly in line with what the progressive wing of the Democratic Party wanted, and certainly he was doing things to appeal to the progressive wing of the party. Now, when we think about what Biden wants to do versus what he's going to be able to do, I think what he's going to be able to do is way more important to talk about, despite all of the attention that went to the preferences during the campaign. So when we think about the potential constraints, so the first one is who's going to hold the Senate majority after the Georgia runoffs in early January. In thinking about that as being a constraint, whether or not, I think the most likely scenario is that the Republicans win at least one of the two seats. But even if there was a slim Democratic majority, where the big spending plans, the big tax increases, with such a tightly divided Senate, it's unlikely that the big spending plans will come to pass, and it's unlikely that the Biden tax plan will become a legislative reality. He's going to have greater degrees of freedom to act in foreign policy and regulation where there are fewer constraints on Capitol Hill. I think the centrists may become much more important in Congress if we've got a narrow Republican majority or a narrow Democratic majority. There is going to have to be, I think, some horse trading across the aisle. I think it'll be interesting to see how Chuck Schumer and Mitch McConnell, as their respective party leaders, how they act in the Senate during the first year of the Biden administration. I think it'll be interesting to see from the Schumer perspective. He likely faces a primary challenge in 2022 from AOC. So it'll be interesting to see whether he tacks left and tries to appeal to the progressive wing of the Democratic Party in New York, or whether he cedes that to AOC and tries to get more of the moderate wing of the Democratic Party in New York. So I think that will be interesting. And I think it'll be interesting to see whether Mitch McConnell, his goal during Obama's first term was to make Obama a one-term president. It'll be interesting in a pandemic and with economic distress, whether he is a little bit more conciliatory and a little bit more collaborative with the Biden White House. So time will tell. I think that both sides will face some incentives to compromise a little bit more, but the market certainly is happy about the prospect for some degree of gridlock in Washington. Relations with China, it's, I think, very clear that rivalry with China will continue. Bipartisan, one of the few areas of bipartisan agreement is with regard to China. There is frustration among both Republican and Democratic voters with China, so I think rivalry will continue. However, we have profound and vast economic links with China. I think the economic links will bind the US and China to an uneasy combination of conflict and collaboration. The difference that I see on the conflict side is that the Biden administration will seek much more in the way of multilateral support in challenging China. In some cases, that will be more effective than President Donald Trump's approach. In some cases, less effective, as it'll be harder to muster a real multilateral support in certain aspects of economic conflict. And then lastly, I think it's important to point out that the likelihood is that Joe Biden will be a one-term president given his age. And what that means is that we really have already started the 2024 election campaign. And I know that probably frightens a lot of you who are totally burned out from hearing political ads and seeing political jockeying in the news. But I think we already have the starting gun's already gone off for the 2024 election campaign. And I think that to some degree will shorten the Biden honeymoon. Now, in thinking about what's happened in the markets this year and where we go from here, the CARES Act was really a big deal. We had consumer spending crater in the early days of the pandemic, and the CARES Act, which wasn't perfect, but had a lot of good attributes to it, boosted disposable income and really was a great safety net for those hurt the most by the pandemic. And you can see that boost to real disposable income helped support consumer spending. So we've in some ways gotten through or had an easier time getting through the pandemic because of the floor put under personal and business losses in the early stages of the pandemic. But if I think about this as a bridge, it's a bridge that's partially built and hasn't been completed. So we lost 22 million jobs. We've regained 12 million jobs. So that's great progress. And on the right-hand side of the page, this is a view of what percentage of job losses have been recovered. Leisure and hospitality, it's 58%, trade, transportation, and utilities, 68%. But my worry is that if we have a rough winter and have a winter in which either voluntary or involuntary social distancing becomes the norm, there's nothing preventing another round of layoffs. So this positive number in terms of jobs regained could reverse course. So I think that's something to worry about. And from my perspective, that necessitates some more of a bridge. And I'm not calling this, I'm kind of stubborn about this. I don't call it stimulus. I think of it as pandemic relief. And I think there's a big difference between pandemic relief and stimulus. And there can be a reasonable debate in the Senate and in the House about what to do and what makes sense versus what doesn't make sense. But it's clear that there are still households and small businesses that are suffering, and without help, they will continue to suffer. And without help, I think the market is vulnerable to a little bit of a correction if we don't do something to boost the fortunes of those that are suffering because of the pandemic. So that's my editorial comment on the political side of things. The last slide on the policy side that I'll show, I think illustrates that we can afford some temporary relief. And it's staggering to me. I worry about the amount of federal debt that we've built up and the rise in debt. But paradoxically, because rates are so low, the net interest expense we are paying today on government debt is far below the net interest expense we were paying as a percentage of GDP 20 years ago. So there is not room for spending forever, but there is room for another part of the bridge to be built. So let's close before Q&A with my thoughts on the outlook. And we'll start with the economic side of things and then talk about some specifics in the market. So COVID-19 progress is very real. I'm really encouraged about the progress on the vaccines, the various vaccines that have been in testing. They've really so far outperformed expectations and outperformed prior trials on vaccines. So that's terrific. There's been great progress made in understanding how to treat COVID. Hospitals are in much better shape at treating COVID than they were in March, April, and May. We've made some progress on the testing side. I still think testing is very important and there's more room for progress. I'm really desperate for there to be a rapid and reliable test that can be rolled out more broadly so that people like us can go back to the office and go back to the office with a higher level of confidence. The second bullet here is the end of the pandemic may be in sight, but there's still a lot to do. The process of mass manufacturing of a vaccine, storing the vaccine, I think about the Pfizer vaccine, which needs to be stored at very cold temperatures, and then distributing the vaccine widely. This is a Marshall Plan type of initiative. So there's a lot that needs to be done before most of us can be vaccinated and feel safe going out in public. I worry about social distancing fatigue. I think we'll see a pickup in case counts after now the Thanksgiving holiday is over. We have Christmas and New Year's and the onset of winter. I think the pandemic is likely to get worse before getting better. And so economic momentum could stall in the early parts of 2021. So this is this kind of strange dichotomy in which I'm a nervous Nelly about what the next few months look like, and I'm really optimistic and enthusiastic about what things look like 12 months from now. And so it's an interesting position to be in because there's a lot that's good that's just on the horizon. We just need to get a little further along on vaccine manufacturing and distribution. So what does this all mean when we think about COVID, when we think about market valuations, and when we think about the policy side of things? What does this mean for markets? And I thought I would highlight a few things before we turn over to Q&A. So on stocks versus bonds, my 12-month outlook is more optimistic. I'm more enthusiastic about stocks than about bonds, given where interest rates are, given what my economic expectations are. I think that investors may be overly complacent about near-term risk, which is why I've been trying to highlight some of the things that aren't so great or that could go wrong. But I think I have a lot of confidence that the vaccine testing and treatment will get us to the other side of the pandemic. And then I think there will be great benefits that come from economic reopening. In thinking about some high-profile segments of the stock market, technology, I see a correction as being much more likely than a collapse. I'll have the caveat that there are some exceptions. There are some companies that I can't explain their valuations. I don't necessarily think that they have a great defensible moat. But when I look at some of the leading technology companies, the Amazons and Apples and the Microsofts of the world, they're solid businesses, solid platforms there. I think they're all vulnerable to slight rises in interest rates, to antitrust or privacy regulation, and to just high valuations. But I think a correction is more in the offing than a dot-com-like collapse. We are on Zoom today, and I love using Zoom. I'm spending way too much of my life on Zoom, but I think it's a great, I really enjoy using Zoom. But with competition from WebEx and Microsoft Teams and Google Hangouts, there's some deep-pocketed competition coming to Zoom. And so that's, I think, an example of one where I'm not making stock recommendations pro or con today, but I look at stocks like Zoom and I need some convincing that those stocks have tremendous upside from here. Healthcare is an interesting, really an interesting part of the market. I see healthcare as being a really interesting long-term sector to be in, benefiting from an aging population and really from technological innovation. And I should really characterize this more as technological revolution when I think about what's happened with the innovation on the vaccine front and innovation in gene sequencing and understanding the genome. Healthcare, there should be some really interesting megatrends that drive healthcare stocks up. However, government policy can help or hurt healthcare. There is the potential for overreach on the regulatory side to harm innovation. So it's going to be a very interesting balancing act for the Biden administration to do things to make sure that healthcare costs don't get out of control and to make sure that there is affordable healthcare for a higher proportion of the population, but doing so without killing the incentive to innovate. That's healthcare. Banks, it's hard to get really excited about banks, but when I think about the segments of the market that have sold off and that have had a really difficult year, if you get an economic reopening, then worries about loan losses will start to ease, and banks that have over-provisioned for loan losses can start to take that money back and push it back into profits. I expect the yield curve to steepen a little bit, not a lot, but even a little steepening of the yield curve would help banks. So I think banks, as we come out of the pandemic, banks should do okay. Value in small company stocks. This is a really interesting part of the market and has rebounded nicely in recent weeks. my business partner, Renee Kwok, TFC CEO, we often talk about how value and small cap stocks are kind of like buying a raffle ticket, and on the raffle ticket it says must be present to win. They move, value and small cap stocks move so quickly that it's kind of a fool's game to try at a time when to be in them. You have to have some footprint in those segments of the market to really benefit from the brief but meaningful times in which they outperform. And I think about actually the 6 weeks following the 2016 election, small cap value stocks were up about maybe 10 or 11% on election day for the year for 2016. When Trump got elected, and there was speculation about him cutting corporate taxes and speculation about a reflationary economic policy, small cap value stocks skyrocketed. So they went from being up 10 or 11% year to date to being up over 30% in many cases in a 6-week period between election day and the end of the year. So I think it's important to have in those segments of the market, but, and there's a big caveat here, there are a lot of lousy small company stocks. There are a lot of value stocks that are cheap for a reason. And I think what you need to watch for are companies that have weak balance sheets that may not get over that bridge to the other side of the pandemic, companies that are vulnerable to disruptive innovation. And I think you can look at certain segments of the economy that may come back somewhat, but in different form post-pandemic. And so think about hotels and airlines. Business travelers like me probably will permanently travel less on business. Those travel companies that are reliant on business travel for their revenues and margins, they may not come back in the same way. They may need to do some things to pivot to different business models. In the real estate space, retail malls are already, in many cases, heading the way of the dinosaur before the pandemic. Their demise has been accelerated by the pandemic. And central business district office space. We've been working, TFC's been working from home quite successfely since the middle of March. And we have a few people that go into the office most days of the week. But we've seen that we want to return to the office, but we've seen that we can be a lot more productive than we ever thought working remotely. So for a lot of companies, I think the days of having workers in the office 5 days a week, 40 or 50 hours a week, that's probably over, and that has implications for office footprints. And I think changing behavioral patterns is also another important factor. And I'll just pick on cruise ships. All of my colleagues who are on this webinar are probably laughing right now because I always pick on cruise ships. But when I think about the post-pandemic world, I've got no appetite to get on a ship with 3,000 people and run the risk of being stranded at sea. Regionally, I think European and Japanese equities are more reliant on exports and manufacturing and would benefit from economic reopening and certainly a less confrontational US trade policy. Going into the election, my expectation was that Trump would enter into trade conflict with Europe and particularly Germany if he were reelected for a second term. That's off the table, or largely off the table under Biden. UK stocks, there's some great companies in the UK, but between their handling of the pandemic and the seemingly endless Brexit saga, the UK can't get out of its own way. If they can get the pandemic under control and we get some resolution in the Brexit saga, I could see UK stocks being a really good place to be. Now, Asia is interesting from a regional perspective. China was first in, and they've been first out of the pandemic. I was on a panel for an Asia-focused conference Sunday night, and two of my fellow panelists, one was from Singapore, one lives in Singapore, the other lives in Tokyo, and both of them are back to really business as usual in their work lives. So parts of Asia are first in, first out. It's definitely an interesting place to invest with, I think, some interesting opportunities, but certainly interesting some risks as well. On the bond side, my closing thoughts on bonds are really, a big part of the battle is defining what you're trying to accomplish with your bond portfolio. And what you're trying to accomplish will really drive what you, how to invest. If your focus is on stability, on having cash that is safe and is there when you need it, then you're not going to get paid a lot on that cash, but there's plenty of places to put your money where you can sleep at night and have a stable principal. If income is important, however, there's not a lot of income in U.S. Treasuries or other government bonds outside of emerging markets. There is a little bit of incremental income available from investment-grade corporate bonds and from municipal bonds, but you're taking a little bit more interest rate risk and a little bit more risk of principal, particularly on the investment-grade world. And then high-yield bonds and emerging markets debt, much superior coupon income, but a lot higher risk and a lot higher correlation with U.S. equity markets. So I think starting out in the bond portfolio and defining what you're trying to accomplish, that's a good place to start. I am in the camp that rates will stay lower for longer, but not low forever. And I think that's an important distinction. I think we'll have a couple more years of relatively low interest rates, but I think eventually we will have some inflation. I think eventually the Fed will come back and raise rates. And so I think inflation is something certainly towards the middle of the decade that we'll be talking about again. And with that, I think we've got maybe 15 minutes for questions and answers. So let's get the questions going.
All right, great. That was great, Dan. Thank you for that. So our first question, let me grab it, is, are tariffs on China positive or negative for U.S. business?
More negative than positive. I am hopeful that some of the tariff back and forth between the U.S. and China abates after Biden takes office. In general, U.S. consumers have really paid the price for our tariff policy. So I think there are better ways, I think, to combat some of the things that we don't like about what China's doing.
Great, thank you. Next question. Do you foresee any serious disruption in municipal bond market in U.S. in 2021, such as spike in municipal bankruptcy?
I don't expect a big spike in municipal bankruptcies. I think that municipalities have a lot of levers that they can pull short of bankruptcy. They entered, even though the municipal finances are a huge mess right now, there are a lot of levers that municipalities can and will pull short of bankruptcy. I think that one of the positives that I can point out is that municipalities entered the pandemic with much better rainy day funds than was the case during the global financial crisis. Now, with that said, I think there are some weak revenue bonds. There are pockets of the municipal world that are troubled, and then there are states like Illinois that have the ability to pay, but not necessarily the willingness to pay. So I think by and large the municipal market will be fine, but I think selectivity is really important in that market.
Great. Thank you again. All right, next question. How long will ultra low interest rates last?
Lower for longer, but not lower forever. I think that we'll see the 10-year Treasury reach 1% over the next 6 months, maybe 1.25%. There's a limit to how much the Fed's going to let rates go up. You know, the Fed's going to have short rates pinned close to zero, I think, for the next couple of years. But I think that the market, as economic reopening takes hold, I think the market will push longer term rates up somewhat, but the Fed's going to intervene before rates go up too much. But I think if you know, I think 2022, 2023, if in an adverse scenario, the Fed's going to start to let the air out of the balloon, and or maybe put more air in the balloon. That the Fed's likely to let rates migrate upwards, and we'll start to raise rates in the short end. But I don't see that as a 2021 issue.
Thank you. All right, next question. What kind of alternative investments might make sense in 2021 as a hedge?
That's a really that's a great question, because historically, through much of my career, bonds have been a great hedge for equity markets and for downturn and in economic growth. That with rates where they are, there are more scenarios in which stocks can go down at the same time as bonds are going down. So I think it's good to think about alternatives. I think that private real estate is an interesting place. You know, core, fully leased real estate where you've got some income generation and some appreciation. I think it's important to know what real estate sectors you're investing in. I'm a lot more enthusiastic about grocery anchored retail stores and about industrial office space and high quality multifamily. I'm more enthusiastic about those segments of the real estate market than I am about central business district office, mall retail. I think those areas face, you know, some real challenges. But I think real estate is a private real estate, public real estate. Public REITs trade more like stocks these days. But I think private real estate is a good alternative. We do some things where we follow some things in the insurance linked market, which insurance, reinsurance, catastrophe bonds, those behave completely differently than traditional capital markets investments. So we think that's different and scary in its own way, but I think a good diversifier. I also like, there's parts of the alternative credit market that are interesting. As banks there's niche opportunities in the credit markets that benefit from a liquidity premium and from what I would consider to be a complexity premium. Banks are so regulated that if it's complex and it isn't big, banks don't want to do it. And so there's some alternative providers of capital that have, I think, some interesting risk-return opportunities. So those are some of the things. There's some interesting things in private equity and private credit. I worry in those spaces about how much money is chasing gigantic deals. But I think in the middle market, private equity and private debt, I think that's more interesting than some of what I see from the big nationally known players.
Oh, great answer. Thank you for that. Next question. Will municipal bonds lose their tax benefit under a Biden presidency? And second part of this question is, how will Biden administration affect Social Security? So two-part question.
Yeah, so I think I'm not worried about municipal bonds, tax deductibility. I think with where the world is, where the U.S. is going, where I think taxes ultimately are going to go up. So I think municipals are attractive, and I think their tax exempt status is safe under Biden. And then on the Social Security side, I can't imagine it is a one-term president that I think we're going to kick the Social Security can down the road for 4 more years. I don't see there being anything resembling a consensus on solving some of the long-term structural problems with Social Security. So there's kind of a good news, bad news thing there. I think ultimately we're going to have a problem. In the near term, I don't see it being disrupted. So the people who, those of us who are worried about potential large changes in policy, I don't see that happening in the Social Security realm.
So Social Security might be part of the 2024 election, but all right, thank you very much. Next question, given the disparate impact of COVID-19 across economies, what international markets or sectors are predicted to perform better as the world recovers from COVID-19? What would be a suggested U.S., ex-U.S. asset allocation going forward?
That's another good question. Well, certainly, I think that the Europe is more economically sensitive. They're more export driven, and they have generally a more cyclical market than the U.S. market. I can see that in the background. My cat is very excited about this question, so I'll try to satisfy her with my answer. So in the reopening scenario, I think that European stocks, industrial, manufacturing, consumer discretionary, I think there's some interesting opportunities in Europe and in Japan. So I think that's we have to get real traction in the economic recovery, but Europe should benefit. And Europe would probably benefit from most analysts expect the dollar to continue to be relatively weak in comparison to some of the yen and the euro. The pound is a little bit more up in the air, and so certainly the weak dollar scenario helps. Would help European and Japanese stocks as well.
Great. So next question is kind of a cost/benefit question, but what is the long-term impact of the major increase in national debt as a result of COVID stimulus/support programs?
I think the answer to that really hinges on whether the COVID programs become permanent programs or whether there's a sunset of the spending. So if this is a temporary relief to offset to keep a liquidity crisis from becoming a solvency crisis for individuals and businesses, and if the spending gradually tapers off, I don't think there's an enormous long-term impact. If on the other side, Washington is really good, Washington and state governments are really good at spending money and starting spending programs. They're not so good at saying, okay, we're done with this now. This has served its purpose and we're done. And if these become perpetual programs and we become a little bit more like Europe in terms of the degree to which there's government intervention in the ongoing government intervention in the economy, I think in the long term that's bad for economic growth, that's bad for interest rates, and I think really I'm hoping that that's not going to be the case. And I think in many ways the market's relief rally after the election was in part relief that there was a conclusive result to the election, but also in part okay, we kind of like gridlock. In the near term, maybe gridlock isn't good, but in the long term, maybe we kind of we want to keep some of the things that we liked as investors about the Trump presidency, and we want to get rid of some of the unpredictability that we didn't like, and maintaining a little bit of the status quo and having some incremental changes. I think in general the markets responded well to that, and I think the market would respond well to a temporary stimulus package or relief package but not so well if they see more of what would be viewed as a government takeover of the economy.
All right, great, thank you. So this next question was submitted, it kind of builds off that a little bit. What effect will another COVID relief package have in the economy? Will it ease unemployment and lead to recovery, or just add to the deficit with little effect? So you answered some of that in that last question. But
the devil's kind of in the details. I think there were the large bill that made it through Congress before the election had kind of a mix of things in it that I thought were going to, in the long run, not be good for economic growth and be problematic from the deficit perspective. If this is a targeted, and the CARES Act was really, not all of it worked, but the CARES Act, most of it was very targeted and was between the CARES Act and what Jay Powell did at the Fed, the targeting was very effective and achieved a lot of the goals without, I think, creating too much of an overhang that we're going to have to resolve in the future. I'm hopeful that whatever happens in the early part of the Biden administration, that it is measured, temporary, and targeted to helping the people that really need it.
all right, great. So another COVID-19 kind of question on the economy. How do you predict that pandemic spending patterns, more online shopping, shorter, more focused trips, will impact the workforce, reduction in retail jobs, and further impact on associated infrastructure?
Yeah, I think that we're going to have an economic transition. I think a lot of retail jobs had already gone away, and so I think that trend will be accelerated. A lot of the jobs that were added in the recent, before the pandemic and the growth in employment, there were a lot of hospitality and entertainment jobs that were added that have since been subtracted. I think a lot of those jobs come back. I think we are still social creatures. I miss going to restaurants. I miss traveling. I've been a broken record about the things that I miss and talking to my family. I think a lot of those jobs will come back as long as we get to the other side of the pandemic, and I'm optimistic about that happening. But I do think that retail is one of the segments of the economy that's permanently changed.
All right. I want to be respectful of everyone's time. We are at 11 o'clock. Dan, do you have a few more minutes to go a few?
Yeah, sure.
Questions? All right, great. So it is 11 o'clock. We're going to answer some of the additional questions that you've submitted. So just wanted to let everyone give you that in case you had something else scheduled. But do you see any targeted relief packages getting done prior to January 20th?
I was hopeful, but no, it doesn't seem like that's in the cards. There just does not seem to be the conversations between McConnell and Pelosi and the White House, and McConnell hasn't exactly extended any olive branches to Biden. I think that really what poisons the water for anything pre-inauguration is the runoffs in Georgia. I think there's a lot of posturing because those runoffs are so important, and I think that reduces the incentives for cooperation between the parties. So I'm afraid the answer is no there.
Down. All right. Can you comment on Tesla joining the S&P and how it might impact indexes?
I'm December 21st is going to be a really interesting day. It is, Tesla's going to go into the S&P 500 as one of the 10 largest constituents in the index. And I would guess it'll be a turbulent trading day, as index funds there'll be a lot of money moving. I can't say that I can remember something this big, a tectonic shift in an index. So I have 3 weeks to figure out what that's going to look like and to wrap my arms around it. But I'm at a loss a little bit to really know what that's all going to look like. I thought there were compelling arguments made to do what I've seen in other indexes, which is to gradually increment the new holding into the index. But the kind of big bang on December 21st it's going to be interesting.
Yeah, especially with a CEO that might be tweeting that his stock price is too high at some point.
You know, he is nothing if not unpredictable and entertaining.
All right, thank you. Again, next question. What actions should be considered in 2020? Example, gifting, trusts, Roth. So anything to comment on that area?
Certainly, I think part of the equation, there's a lot of moving parts here, and I have colleagues that are better equipped to answer the question. But I think you know, the part of one of the things that you have to look at is, well, has this been a pandemic affected income year for individuals? What does your income look like this year versus next year? That has, I think, a lot of influence over whether you do more or less gifting this year, whether you accelerate income or not. That's, I think, a good place to start in thinking through what your year-end tax strategies look like. I'd say that the tax code, going back to my earlier points about policy, I don't see dramatic changes to the tax code in 2021, and so I think that is a positive. But I do think that the general direction of taxes is going to be up, either because some of the Trump tax cuts sunset, or because there is momentum towards tax increases. I just think that the dramatic changes in tax policy are, I think, off the table for 2021. But I think there's so many moving parts. It's hard to have a one-size-fits-all set of recommendations. That's why you should talk to your your good friends at ALL CPAs.
Still the words out of my mouth. Thank you very much for that plug. Second to last questions, and thank you again for sticking around, Dan, as well. So second to last is, what might a CARE Act 2 look like if there is another round of funding?
Yeah, so I think I'll just share my wish list. Extended and enhanced unemployment for displaced workers, including gig workers, gig type workers. That would be number one. More support and more and broader support to small businesses. I see businesses shutter wherever I go. I see businesses that are closed down, and I think there's some learnings that can be applied to another round of small business help. I would like to see some help to municipalities, to states and local governments. I talked about the levers that they have to pull in order to avoid defaulting on debt. Those levers aren't very pleasant. They involve either reducing services or reducing headcount. Those aren't particularly attractive. That's become really a political minefield, blue state versus red state. I really think it's an all states issue, and I think some relief is necessary there, and temporary relief, not money that goes to fill in Illinois' pension gap or New Jersey's pension gap, but things to keep services going, because states and cities have been hit so brutally hard by the pandemic. The last thing, and at the risk of being in Massachusetts, this is a heavily Democratic state. Full and fair disclosure, I would consider myself a moderate Democrat, but as somebody who helps run a business, I think Republicans have wanted some degree of liability protection for business to be built into whatever relief package comes into play. And I think having some relief from liability, I talk offline to a lot of CEOs who tell me that they are compassionate employers. They don't want to force their employees to come back to work, but they want their employees to come back to the office eventually. They're losing out on a lot by not having workers in the office. But they're afraid of liability associated with bringing workers back if there isn't some form of protection. And it doesn't mean that bringing people back and having full coverage for anything that can go wrong, but if employers take reasonable steps to keep their employees healthy, whether it's deep cleaning of the offices, social distancing, all of the things. I look at what our office manager, Betty Harris, has done to enable our skeleton crew to come back into the office. And it's fantastic. She's done fantastic work in helping us come back to the office, to have a handful of people in the office. Businesses need to know that if they take the proper steps to protect employees, that if something goes wrong, they're not going to lose their business because of lawsuits. So I think that should be, in my perfect world, that would be part of a pandemic relief.
That's great. So the last question we have, it's kind of a Green New Deal question. It's how does an agenda of combating climate change, lessening dependence on fossil fuels, or the opposite of continuing business as usual impact the outlook?
Well, I think that we're definitely, there will be a sea change in Washington under Biden, and I talked about him having more levers to pull from a regulatory perspective. I think that he will put people in place that are friendly to the concept of a transition away from fossil fuels, hopefully an orderly transition. I think that I think you'll see executive orders and signals on the regulatory side that start from day one of his presidency. And so I think that presents some interesting opportunities in the clean energy space. Although certainly clean energy stocks have done extraordinarily well in the lead-in and in the post-election period. But I think there's a whole host of investment opportunities that I think are out there because the world needs to address climate change. With that said, I think the transition is going to be a lot longer from the world we're in today to the world that we want to be in. It's going to be a long transition, and while I think there may be some opportunities in traditional energy as well, because we're probably a decade away from, or longer, from transitioning completely away from fossil fuels. So there is a price at which some energy stocks might be attractive. Maybe not all energy stocks, but I think there's some probably interesting opportunities in the old energy world as well as the new energy world.
All right, great. So we did have one last final question. I'm sorry for one more. So after this, if you have any more questions, just please email us and I can forward them. But do you foresee the Biden administration adding regulation for tech companies?
Yes, we're trying to figure out what that will look like. I think that Kamala Harris has pretty good ties with tech companies from her history in California. I think she understands technology well. I think Biden is generally favorably favorably disposed towards technology, but I think both Biden and Harris see the the issues with technology companies, and so I think they're going to face some challenges in the U.S. on the antitrust side. That's going to be harder to define and defend. But I think the Facebooks of the world have done a lot of what I would call catch and kill acquisitions, where they've bought out companies that could potentially encroach upon their turf, and either they've integrated the company into their operations, or they've just kind of sidelined the companies. I think those kinds of activities will be scrutinized more heavily by a Biden administration. I think privacy is still a big deal, and really European regulators have led the way on the privacy side. We're not done with privacy being an issue. And then on the European front, the technology companies are very vulnerable on the tax side. There's been a lot of tax location shifting, and European major countries in Europe are not at all happy about that. And so I think there's some vulnerability as we go forward. And certainly technology companies are not the only ones who have shifted revenue to tax-friendly locales, but technology really stands out. And so when I talk to my contacts in Europe, they've highlighted that as being an area that's still going to be under scrutiny. And so it's not all clear sailing ahead for technology companies.
Thank you very much. On behalf of ALL CPAs, I'd like to thank Dan for presenting today, and TFC Management for putting this presentation on. Thank you very much for also sticking around and answering these extra questions. I know we went a little bit over time. Everyone else, we will be sending out a recording of this presentation. And if you have any additional questions, you can always reach out. Dan, any parting words?
Just thank you. Thank you so much for joining me today. And